Good morning, traders. Today is October 1st, the beginning of Q4 2023, and boy, are we looking like we are about ready to enter a very interesting time and dynamic in the market. This is a special video update produced by Ment.com, myself. This is particularly related to what looks to be a new downward cycle phase that is taking place, an unwinding phase post-COVID. And I want you to understand where we're at with this and how the markets reacted to the actual COVID, post-COVID and COVID-related events. So first off, we had COVID. It shocked the market, shut down the global markets, shut down consumers, didn't know what was happening. The Fed reacted and global central banks reacted by making very easy money policy where consumers and traders were able to take advantage of a huge speculative wave after the initial recovery, the downward spike that occurred with COVID. And that then prompted a huge move in the markets. Housing all of a sudden started to take off. You can see it right here. Try to drag this up. March 2020, price reduction count collapsed. Okay, median days on market shot up. That's when everybody went into a panic mode. And this is basically the shock period right here. Nobody knew what to do. Okay, by May, June, July, all of a sudden, people were buying and moving houses. All of a sudden, you see median listing price start to increase. You see active listing counts immediately start to collapse. And by March, May of 2021, we'd reached our apex in buying. This was pretty much the apex in real estate buying and activity. At this point, we start to see the numbers start to move back into normalized territory. Prices are still elevated. Okay, the actual total number of listings, active listing count, which is the orange line, starts to increase. This is where people are trying to get out before the Fed raises the interest rate. And people were still buying at these elevated prices, trying to get in before the Fed raised the interest rate. So think of these as the last-ditch buyers trying to get in. And then we see the Fed start to raise interest rates over here. Active listing counts increase. Prices continue to elevate. Sellers are still believing they can get their price. Just wait it out. And again, this is where everybody was saying, hey, the Fed will probably change directions in 12 or 15 or 16 months. Here we are 12, 15, 16 months later, and price reduction count has collapsed. Active listing counts have collapsed. We're really seeing median days on market collapse. And what's happening here is we've gone into kind of a shock territory, another shock territory. We're back down in these flat line areas. We're seeing very little growth in price activity. And we're starting to see an increase in price reduction count. But what's really important here, ladies and gentlemen, is again the dynamic modeling. Dynamic modeling is showing weakening trend. And what we have here again is we have a downward spike in activity. So the heat rank here has strengthened a little bit. The tightness rank is fairly flat. The inventory strength is fairly flat after being down. And then we have the seller desperation also being fairly flat. So now let's come over here and take a look at the price trends. Price trends have moved decidedly downward. We're now at minus 300+%. Okay, price reduction activity is starting to tick higher. This is good. We saw it move higher over here and then collapse near the end of 2022 into early 2023. This was probably because the market started moving higher. The general stock market looked like we were recovering. People started anticipating the Fed would drop interest rates or reduce the rate at which they're raising interest rates. Real estate active listings have come from these deep lows in January, February, March 2023 up to these new highs. So we're getting a big increase in listings right now, and we're getting our new listing counts rolling a bit upward. Okay, so you can see here starting to roll back to the upside. But what's really telling, ladies and gentlemen, what is really important is this. This is the custom hostility index. It is pointing downward very strongly to the downside. This happens, in 2008, 9, 10, during market contractions. In order for it to move down into a solid opportunity, we need to see a very big decline. And this would mean that the housing market is getting ready to burst. Okay, I'm talking about bursting, kind of like we had here. Here's COVID. This was the shock event that burst everything. But remember, interest rates were near zero, of easy money. It rolled back around and elevated. Now we're getting a burst event with interest rates up near 8%. Consumers are very stressed. We're getting a very big downward move, and I believe this is a bubble bursting taking place in the market. Now, let's take a look over here at U.S. stock market valuation. This is a custom U.S. stock market valuation chart. What this tells us is that whether we're in an appreciation phase for value or a depreciation phase for value. Value is the underlying expectation of economic growth or not. Think of it as the organic growth model. If we are confident that the markets are going to move higher, the economy is good, there's no headwind, there's no craziness, then we'll move into an organic growth phase like this. If we have headwind, if we're not sure, if traders are concerned about the economy or the future of the economy, then we move into this devaluation type cycle phase. And even though we stalled over here the last couple of weeks, you can see that we've now moved decidedly downward. This is a new wave of downward price pressure that is going to take place and is likely going to drive prices much, much lower as China and Europe and Southeast Asia, including the U.S. and major markets, so I'm going to include pretty much everybody, Canada, Mexico, Europe, Japan, you name it, the entire globe, is likely to experience a moderate to severe credit crisis between now and the end of 2024, which includes the presidential election cycle. This downward move right here is very indicative of a crisis event setting up when it's paired with that real estate index chart moving downward. So we have a very broad downward cycle index taking place. And additionally, we have, if this is the right chart, we have gold and silver moving into a panic selling phase, which happens every time we get into a crisis mode. So understand that we're now looking at a broad crisis mode, early stage broad crisis mode in the global economy, which could be very, very difficult for traders and investors. Now, I wanted to point out a couple other things while I have you here. First, let's take a look at the technology index. Double topping, stalling, potentially rolling deeper downward. This could be another 20-25% collapse in the global markets, in the technology sector in particular. It could be very damaging. I want you to be aware that there's a very strong chance of a credit market event globally over the next 12 to 16 plus months. The Fed could do what they want to do, but they're still trying to tamp down inflation. I believe this is going to be a very difficult time for traders. A lot of volatility and possibly new lows, meaning getting below the October 22 lows. Secondarily, we have the U.S. and global markets. This is the U.S. chart here. This is the global market chart here, moving decidedly downward. Last time this happened was back over here in early 2022. You can see the U.S. and global, actually late 2021, started moving downward together. This was the big reversion event. This was the speculative rally after COVID. You can see now we are moving downward decidedly. We're at kind of a support level here, so the next week or two could be very telling. We might get a bounce, a little bounce here, but I wouldn't buy into it as a long-term trend. I think we're going to be moving downward, trying to get down into these areas, maybe down into these areas, maybe retesting even deeper lows. But understand that we are in a downward cycle trend, very clearly moving downward, And I wanted to highlight the fact that the global asset index has stalled and is rolling downward. Looks like it's going to roll downward very aggressively. This is a monthly chart, so understand that we could have quite a bit of downward activity here. This is, take a look at this, this is the rally phase after COVID. So understand that we've stayed elevated with the global asset index. We've come down to these lows, which are moderate lows. We could see this wipe out and come all the way back down into this lower 0.75, 0.80 level on a deep contraction. Secondarily, or next, we have the U.S. large cap index, which is doing the same thing. Very elevated, very toppy, multiple little dojis rolling potentially downward. You can see these arrows here. It looks like we've topped out. We're rolling downward. And again, if we get into a credit event, global credit event related to real estate, related to banks, related to valuation, we could see kind of the foreign markets leading a collapse event that is going to be very similar to the global financial crisis, but in my opinion, this time it's going to be initiated by foreign markets. China, Asia, Southeast Asia, maybe Europe, maybe Canada, and what would happen is this pressure would push the global markets into a deep reversion, a deep move, possibly trying to move down into these areas here. And in fact, let me come back over here to the U.S. stock market. So you can see here, this is the October low, September, October right here, 2021, 2022, the base bottom. This is our rally phase. We got above these resistance areas. We rolled over right at the middle channel here. We're moving downward. We're at the last line of support right here. This little blue line right here, the cyan line is last line of support. This is a weekly chart. We're very close to this green price amplitude arc, which is a major trend change. And I believe, ladies and gentlemen, we are going to push downward into these lower channels, possibly setting up a new deeper low down here in this 800, 840 area, which would indicate that we are now in an A, B, C move down to this area, potentially moving even weaker. Understand that the Fed is doing their job to try to tamp down inflation and curtail the excesses that were taking place after COVID. They will likely keep the pressure on into 2025, maybe 2026. We have not yet seen a proper unwinding of the excesses in the U.S. and global markets. We're kind of just floating around in a what comes next mode. While I think what comes next is a moderately strong downward trend, the U.S. markets may hold up better than global markets this time. But I believe the global markets will lead the credit crisis like what we're seeing in China. I believe it'll move throughout Asia and other areas of the world, and it could affect the U.S. market, so you need to be very, very cautious moving forward right now. The actual globe is pending in a crisis mode, and what I want to show you here, once I find the chart, is the actual leading index, which is a forward-looking kind of leading index indicating where money is going and where it's not going, is telling us very clearly, almost 2 months ago, we broke through this trend to the downside. Money is now leaving the markets. Traders are very, very cautious. They're very fearful. Like I said, we're in the beginning of what could be a very big global credit event. We'll see how it plays out through the end of the year. My expectations are that we're going to try to find a base or a bottom somewhere near mid-November, maybe late November. But again, I will preface that by saying that if a broad credit event begins to take place, this could roll much deeper to the downside, meaning that we may not find a bottom in November. We may not find a bottom in December. We may try to find a bottom in 2024, a secondary bottom, but it's looking very dangerous right now particularly with that real estate breakdown. That is the deepest breakdown we've seen in the real estate hostility index in years since COVID. It's almost like a shock to the system has taken place again. And I think that shock could unwind and play out as a very deep market correction. So be prepared. The advice I have for you is protect your open trades, allocate your trades effectively, meaning reduce your trading size, and move more capital into a cash reserve. If you have not yet hedged, the gold and silver prices right now look very attractive. But again, this is a very big warning sign. All of my indicators are saying that the market is moving downward, and we now have a pretty good sign that a credit crisis event is beginning to unfold. Okay, guys, follow me at Ment.com. Here's my website. You can see what I do. I try to deliver the best research I can to help you stay ahead of this. Remember, I was actually telling you to protect your positions over here in this last little rally phase, knowing or expecting this rollover to happen. So if you want to stay ahead of the markets and you want to learn how to protect your capital and grow your capital efficiently, come check out Ment.com and learn how I can help you. All right, guys, that's it for now. Talk later.